Take a seat.
Now, as a result, policy is turning more and more aggressive. We saw yesterday the Swedish central bank cutting rates by 175 basis points, the ECB surprising everyone by cutting by 75, and of course the United Kingdom is now at rates only seen during wartime in history, the lowest rates in history. However, I think that policy action is coming too late. Monetary policy operates with a long lag. You cut rates, of course, people feel good, stock market goes up for a few hours, but the real effect of monetary policy takes 12 to 18 months to take effect. Fiscal policy, massive projects are being lined up in China, in the United States, and so on, but the reality is that these things take time to come through and actually affect the economy. The trouble is, the economy needs demand right now, and if the trajectory is so sharp and the damage is done now, then it will lead to all kinds of other second and third round effects, so that by the time the fiscal easing and the monetary easing really helps, it's too late. And that's the issue we have today. And all that they have done so far still leaves the credit mechanism basically very weak. And without the credit mechanism functioning, more bad news will come through. Moreover, I would argue that policy has not addressed some of the critical features of what we need in policy. One is, everyone knew for the longest time that the automakers were in trouble. Everyone knows today that there are going to be huge foreclosures in China. Yet there is no systematic, institutionalized approach to anticipating such events and doing something about them before the damage really comes true. So you look at the GM thing, everyone knows these guys are in distress. Even when Mr. Wagner and company have forsaken their private jets for hybrid cars and driven up to Washington, they still cannot agree on a package. Now, the key thing about this is not so much that GM is going to go bust. We all know that. In some form or other, it's gone. The problem is the second and third round effects. The pension liabilities in particular are huge. And if the pension liabilities are defaulted upon in some form, then the entire household sector in the United States is going to be very worried about their future pensions. And they will save more, they will cut back on consumption. So there are going to be all kinds of second and third round effects, which the market, I think, is now fully priced in when the GM, Ford, whatever, bankruptcy occurs, or when the airline bankruptcies occur, or when the retailers go bust and so on. Secondly, there is no systematic approach yet to deal with the disposal of bad assets. In the Asian crisis, what was the thing that really helped was when we could identify, quantify, and apportion the losses. There's no systematic approach yet, which is why when Paulson said that he's converting the TARP scheme to a recapitalization scheme, the market fell, and there were all kinds of other stress points that emerged. Thirdly, there is a lack of global coordination to tackle issues which only joint action can tackle, particularly the collapse in trade finance. This has to be done jointly with the issue of things like guarantees and so on. You also know that there are emerging markets like Korea, Indonesia, Hungary, the Baltic states that are very, very close to crisis. And again, although a few patchy efforts are being made, not enough coordinated action is being taken. So there are going to be more problems in the emerging markets. So what do we expect in the coming few weeks? And clearly major bankruptcies, not just GM and all that, but a whole host of other names, some of which will be iconic names in the UK, in Europe, in the United States. Secondly, I think a lot more bad news on China will start coming out. Now, why is it I sound so negative on China? It's not because I say that in the long term China is going to be a basket case or anything like that. China will do extremely well in the long term. But I think China is going to go through a very difficult 1 to 2 years. And I think it's important to understand that what they're suffering from is a confluence of negatives. It is not just the weakening in external demand that is a problem. The first problem is that some of the excesses in China, the bubbles that built up, are now bursting. The housing bubble is the most prominent example of that. And of course, housing has tremendous multiplier effects throughout the economy. Right? So that's already coming through. Secondly, since about the middle of last year, the manufacturing sector has been going through a major restructuring because costs have escalated, environmental impact becomes more important, all these issues. And as a result, half of the toy makers in China have gone bust, significant number of garment manufacturers are no longer competitive. And this is a very painful structural adjustment independent of what's happening in the global arena. But if you're in the middle of a painful adjustment and then you're hit by other shocks, of course your resilience is much lower. And that's the problem China has. Now, the other issue is that when you have such a downward, sharp trajectory, it can spark off other stress points in the economy. Now, a lot of people say that Chinese banking sector has been cleaned up, and it is true if you look at the formal banking sector. But because of financial repression, you now have an extraordinarily large illegal banking network. And some people, and these are people I know in the People's Bank of China, central bank, will tell you that this illegal banking now accounts for 20 to 25% of new lending in China. Now, when you have a housing bust, asset prices coming down, unanticipated economic weakening leading to corporate cash flows coming down, that is when an illegal banking sector that has no capital adequacy, no risk assessment process, that's when it goes bust. And I think we're on the verge of seeing major financial stresses in China as a result. Now, of course, the Chinese policymakers are very good. When confronted with this problem, they will deal with it in a very effective way. But the fact is, I think it's too late to avoid this problem from unfolding. So more bad news on China, in addition to the problems in the emerging markets that I see. Okay, so what does this mean? I think it means a very, very poor outlook for economic growth. I think the IMF is way behind the curve. If you look at their forecast, they're looking at Singapore economic growth of 2% next year. And at the briefing when they were asked, oh, isn't this a bit behind the curve? They say, oh, we might change it down to 1.75%. You know, they're way behind the curve. Things are going to be much, much worse. Major recessions everywhere with the real threat of deflation. Because when you have asset prices falling, plus credit mechanism breaking down, plus very severe economic weakening, you get bad deflation. Not the good deflation that, you know, food prices fall, energy prices fall, everyone feels happy. This is bad deflation where debt levels, the real burden of debt becomes so great that more and more people go bankrupt. This is the kind of thing that we possibly face. So I think the real bottom in this crisis comes when governments in the US, in Europe, in Japan face up to the fact that traditional tools will not work, and they have to resort to things like quantitative easing, printing of money. And I think that is going to happen sometime in the next few months. And I think you should need much more massive fiscal spending and also a whole series of government guarantees and things like that in order to get trade financing and stuff like that moving again. So what does this mean for Asia? Well, the fact of the matter is that it is not just through trade that Asia will be impacted. Trade is of course important, but trade is also a generator of income for households. Household incomes come under pressure. What we think of as domestic demand goes down because people become more cautious, they have less overtime, less bonus, they're worried about the guy in the Intel factory who's been fired, they're worried about their own jobs, they cut back. So what appears to be domestic demand will also weaken, even though it's a purely external shock. And then, of course, you have the financial crisis causing asset prices to fall, banks to become much more cautious, and funding problems will cause large projects to be deferred. We've seen it in Singapore with SANS, with the large petrochemical complex, 1 out of 3 postponed, with the big chip plant, $5 billion investment postponed. God knows how many other things are going to be postponed as well. That means a slowdown in Asia. So the foreign investor may want to come in, but he can't get funding, so he has to postpone it. And I think we see a lot of that as well. Tourism will be down, remittances will be down. That affects the Philippines, India, Bangladesh, Pakistan, and Vietnam. Commodity prices down, so households in rural parts of Malaysia, Indonesia, Thailand in particular will be hurt. And of course, foreign investment will continue to fall off. So
take a seat.